I only specialize in what I call the really great bubbles.
What is going on YouTube? It's Brendan from Market Makers. This is your SPX video. These will be coming out every Sunday and Wednesday. Guys, we need to talk about the bubble cycle that we are trading in. I want to show you where I believe the market is going to bottom, and then what will happen next, and that price target and time, okay? Because we're in a cycle that has repeated twice in the last 22 years. And I'm talking about a 3 sigma super bubble. And when these pop, you have catastrophic declination in price. We're talking about Amazon and .com trading at 138, going down to $6. We're talking about the NASDAQ going down 84%. And what if I told you there is a way with natural cycles, esoteric cycles, to determine key pivot points in every single super bubble we've had now, this being the third one, going back since .com. I'm going to show you that today on this channel. I endeavor to bring you advanced Fibonacci concepts, Wyckoff, as well as esoteric concepts, because I do believe if you understand the macro, if you understand how cycles work, cycle trading, this makes you a better trader, and it greatly enhances your forecasting ability. And that all starts off with how you view the market. Guys, this video is going to be brought to you by SimpleFX. If you want to trade any of these equities, commodities, Forex, anywhere around the world, check out SimpleFX. The link is in the video description. With our link, you do get a special double bonus up to $5,000 instantly based on your deposit. You do need a VPN. All the details are in the video description. It is a fantastic exchange where you can trade with only an email, totally anonymous. So let's go ahead and dive into this. What is an esoteric concept here that could tell us tops and bottoms in the marketplace, key vibrational pivot points? You're only going to get this information here, and we're going to go over it in this video. So the equinox dates are very important to understand. The spring equinox, the fall equinox. And this is not astrology, guys. This is a natural cycle. Traditionally, in the northern hemisphere, the spring equinox, after that occurs, is when you have the beginning of your agrarian cycle. That's when you do your planting, and then you're harvesting in the fall. So you have to understand, like Plato said, the path and cycle of growth and decay are one and the same. And if you understand that markets make patterns, markets adhere to patterns, whether you're in a cycle of growth or a cycle of decay, you can have more accurate forecasting for what the market's going to do. But let's get our baseline. Perhaps you think the market is bullish. Perhaps you watch a lot of media on TV and they tell you that we're breaking out, going to new all-time highs. And this is not going to be a bad year for stocks after all. Maybe it's just going to be flat. Well, let's do a couple of things here. Let's look at the pandemic low and come all the way up to the all-time high. That is a 119.84% increase in price. Now, let's go back to .com. After .com, the S&P was traditionally gaining about 8 to 9% a year. After the great financial crisis, the S&P started gaining 10 to 11% a year. This is because of all the stimulus that was put into the marketplace. Okay, so traditionally you're gaining, let's just say 10% a year. Prior to .com, it was 8%. So 10% a year. Now, in 651 days, let's round that up to 2 years, 651 days, you went up 120%. You 6x'd your normal 2-year return. This gave you a 3 standard deviation, a 3 sigma super bubble, which is why price is collapsing. To get this type of growth required massive stimulus. In our country alone, $10 trillion in stimulus was required to see this type of inflationary environment in the market. And in monetary policy, we had record 40-year high inflation. So now when you understand these concepts and you start to think, well, but how does that affect where we are now? Well, where we are now is the Fed is moving towards 5% interest rates. We've been basically at 0% interest rates. So they're going to tightening. M2 money flow is basically zero, okay? New growth money flow. It is basically zero. The Fed is tightening. It is unwinding meaning it's $6 or $7 trillion on its balance sheet. You have a $31 trillion national debt, and we just hit our debt ceiling. By the way, last time we hit our debt ceiling in 2011, the S&P dropped 15%. So we have a massive yield curve inversion in the bond market as well, going back for 40 years. Whenever we've had a yield curve inversion at this level, whenever we've had inflation above 5%, every single time we have had a recession. So when you hear the soft landing narrative, they're ignoring the market past. Okay, you have to study the markets. If you have inflation above 5%, 100% of the time, historically, you have had a recession. If you have the yield curve inverted as it is, 100% of the time, you have had a recession. The reason that's important to understand is because we have a number for what the S&P averages on a decline in the recession, and it is 33 to 35%. So you're looking at least a minimum of a 1/3 drop in the S&P, which means the S&P is going to drop more from where it is. Now, if you do believe, as I do, we are trading in a massive bubble, then there is much more decline to come. But we're going to go over these key pivot points in the marketplace, looking at the two previous bubbles as well, because this is a very important concept to understand. If you want to look at the Earth perigee here, January 3rd, 2022, S&P made its high January 4th, 2022. Earth perigee is when the Earth is closest to the sun, and the sun's the biggest it's going to appear in the sky for the whole year. The very next day, the S&P makes its high. The S&P's been on a decline since then. The spring equinox in green gave you a reversal of trend. The equinox dates tend to be vibrational pivot points for price. They make tops, they make bottoms, they trigger crashes. Now, none of this is a secret. As a matter of fact, if you watch the business news, you just hear them use this term, seasonality. The Santa Claus rally, that's the winter solstice, but they say seasonality is behind us, or traditionally this is a bad season. So you have the spring equinox, a vibrational pivot, price goes up, price then declines another leg. Fall equinox, another pivot, price waves up and price gets rejected, and I do believe we are printing a massive double top here, and we're going to get into that in the smaller time frames. The Earth perigee date was the anniversary date for the S&P all-time high this year, January 4th, and of course we came back up, and I think we're going to top out and move down. The spring equinox for 2023, guys, looking at that March quadrant, the correct way to view this is not by the actual day, but as a quadrant for a vibrational pivot, okay? I think we're going to top out, and I think we're going to decline and look for a pivot, a bottom in the marketplace, that March 20th, 2023 to early April, and then you will have a massive rally in the S&P. But let's go backwards and look at these other equinox dates and see how they played out. Pandemic crash, spring equinox, gave you your bottom, vibrational pivot, back to the upside. Let's go back even further. 2018, this doesn't look like a big deal. Here's your fall equinox, gave you a market top, and then what happened after this? Well, let's look. This gave you, let me go ahead and get this, I believe it's about a 20% decline, a market crash. And if you see this, 20.18% right after the fall equinox. Spring equinox 2018 of March, just before that in the weekly candle, vibrational pivot, back to the upside. This is because if you understand, if you view time as a circle, the spring equinox is 180 degrees on the circle, and the fall equinox is 360 degrees, the completion of a cycle. On the Gann calendar, these were 45 angles on the Gann calendar. This is why you see the greatest crashes, bottoms, and triggers to crashes always happen in that spring equinox or that fall equinox time frame. And you're going to see this here on the charts. Let's go back even further, guys. Let's go back to the two great bubbles that we have had since the last 22 years. Looking here at 2007, 2008, the great financial crisis. Spring equinox of March of 2000, you get your pivot up off the bottom. You come up to make a top. Your fall equinox, you get your top a couple candles later on a weekly time frame, begins your decline. Spring equinox, March 24th, look what you do. Again, vibrational pivot back to the upside, rally doesn't hold. And then on the fall equinox, September of 2008, the greatest decline in the crash, it happened in September 2008, where you made your bottom in the spring equinox of March of 2009. There's a lot of numerology in the markets. There's a lot of patterns in the markets. The bottom of the S&P in March of 2009 was 666. The Dow had its greatest one-day crash during the Great Financial Crisis, and it was 777. So 777 points in declination. Let's go back to .com, because this is the pattern that we are trading most closely to. And there's a lot of key pivot points here, as you're going to see with the spring and fall equinoxes. So spring equinox, March of 2000, okay, March of 2000. This is when tech, media, telecom was approximately 34% of the S&P. And as you can see, what happened after March of 2000, you get your fall equinox, declination. Spring equinox, a reversal, a pivot, 180 degrees, an about face, a pivot. It does not hold. You fall back to your fall equinox, again gives you a market bottom to the candle, by the way, a reversal back to the upside. Spring equinox, March of 2002, once again declination in price. Do you see this? So the price came down, and then in the fall, September 23rd, 2002, couple candles later, that was your market bottom. The spring equinox of March of 2003 gave you your pivot back to the upside. The equinox dates will not hit necessarily on that exact date, but it happens within a couple of candles. This is why you see the great crashes, like the crash in 87 happened in September. These dates, these months in these equinox dates come up over and over again in these marketplaces. It's very important to notice this, because the market moves in cycles and it moves in patterns. Guys, if you want to see a fib level, let's look at this. Let's go over here to the left, and let's look at this 20% decline here. 22% decline. It's a good spot to take a fib retracement from this low to this all-time high. We can go ahead and do it like this. The low to the all-time high. And we have, let's go ahead and add some fib levels to this. I want to focus on one particular fib level, the 1.128. Okay, 1.128. You can see we clicked and hit the 1.128 off this fib retracement. This is the .com crash. Okay, now these are cardinal points in the markets, the equinox dates, and let's look at 2008, and we need our low. We need our low here from the last crash, doing a simple fib retracement up to the high here of the Great Financial Crisis. Where did this fall to? It wicked the 1.128. Do you see that? 1.128 once again was hit. Now, those are two crashes that happened back to back, 2 3 sigma bubbles. Let's go to the pandemic. Could you have found the exact same fib on the pandemic? Let's check this out. So we have our 20% crash here from the 2018 crash. Let's go ahead and take that low. Go to the fib retracement up to the high right before the crash of the pandemic. You knife right through the 1.128. There seems to be a relationship with the 1.128 Fibonacci, as well as all of the major 20% plus crashes here in the S&P. As a matter of fact, simple fib retracement, obvious starting point here, using the pandemic low, going up to your all-time high, this meteoric rise. The 1.128 lands you at 1855. What's interesting about that number, let's go ahead and do a drawdown to this number. What's interesting about that number, to come down to the 1.128 lands you at exactly Fibonacci 618. Here it's minus 61.42, but this is essentially a 61% drawdown in the market if the market decides to hit the exact same fib level it has for every major crash for the last 22 years. Now, this is some esoteric concepts. Nothing has to happen. Perhaps the S&P breaks out and moves up and makes a top for the spring equinox. But again, this matters how you view the market. If you are bullish on this market when we are heading towards a near guaranteed recession, well, that's one way to view it. But if you are bearish because you understand the macro trends, that is very important to understand. You can decide and decipher for yourself. Guys, we went over Dow theory before on one of my combined videos, but in a bear market, you're looking for a 20% price declination of price here to enter your bear market according to Dow theory. Gets us right down here, 20.93. We want to mark off this rebound to try to defeat the bear market. Gets you at 42.04 here on the 3-day chart. You see that? 42.04. So let's go ahead and delete this. And then we saw the big June rally try to defeat this. This is why, if you are watching the business news, if you know who Tom Lee is, this is why you see people who don't understand technical analysis is how bear markets work. Oh, the bottom's in. June bottoms in. As a matter of fact, the same person, not trying to throw shade on Tom Lee at all. He does what he has to do, I guess. But when we pulled back on the S&P here, he said this was a generational buying opportunity. And in December of the prior year, prior to making our all-time high, he predicted a new all-time high for this coming year. There's a reason for this. I'm not picking on Tom Lee. The reason for this is 90+% of the money worldwide is long at all times. Think of the massive funds in the marketplace. It is long. Okay, shorting is an art. Many people never have shorted before in their life, so there's always a major bullish bias to the marketplace. But this is why this is a bottom. This is a bottom, and we're breaking out here, and now we're breaking out here. This is how bear markets work. You get massive rallies in bear markets. In the 1970s, after that 72, 73 crash, or during that time period, we had a couple 60% rallies. For .com, we had 6 or 7 rallies that went over 25%. You get massive rallies in a bear market, but economic conditions are deteriorating. This past week alone, or last week, we had 100,000 layoffs announced by big tech. Guys, the unemployment rate is at 3.5%, a historic low. You would think that bodes well for a strong economy. Not true at all. Historically, whenever we've got down to this level of unemployment, it is very bearish. It works inversely. Higher unemployment is more bullish, more opportunity for growth. Okay, these cycles always repeat themselves. And this is also why we go over the VIX when we talk about this marketplace, because we hit our bear market top at 18. And then what happened, guys? We sold off. The S&P had its worst day in a month. The Dow dropped 600 points. And where are we now looking at this chart? We know we have to flip 42.41 in Dow theory to break this bear market trend. So we need to break out, need to come up, break out, maybe get a nice double bottom here and move up, right? This is the bull thesis for this year. Move back up. What it looks like to me, what we are doing here is printing a double top. But in general, we also have a lot of Fibonacci confluence here. Let me show you this. So if we take this same trend-based fib here, let's go from our all-time high. Let's do the June rally. This is the largest wave up, okay? So we're going to do basically an ABC projection. I'm looking at market symmetry, a key concept in geometric trading. The 1 fib, 31.41, tells me that's our target. And when I look at this using Fibonacci patterns, I can show you this just like this. There's your rally, and then here's your target, and I'm looking at that spring equinox, okay, in that quadrant, that March 20th, 23rd quadrant. I'm looking at my ratios here. You're between spot 5 and 618. If this was a spot 5, you'd be looking at the reciprocal ratio of 2. This gives you 1718. If this was 618, you'd be looking at the reciprocal ratio of 1618. Now, what's interesting is when you're looking for Fibonacci confluence, one way you can do that as well is measuring this double top. Okay, if we were to measure this double top coming from here with a trend-based fib, let's look and see what this would equal here. If we throw on the 2618, do you see this on my screen? Watch the 1 fib, 31.41. I'll get rid of these other numbers here so you can see this. 3141. Let's throw on the 2618 from this apparent double top. Okay, would that 2618 get hit in a crash situation, VIX going above 40 or 50, I do believe it's going to get hit. There's some Fibonacci confluence here for this massive double top to come down to my 3141 target. And guys, this is not a crazy target. Mike Wilson, and this is for the spring equinox, Mike Wilson from Morgan Stanley, who won TA Person of the Year last year on Wall Street, he just lowered his target to 3,000. And of course, Mike Wilson said by March or April, because he thinks earnings are going to come in bad. Now, March or April, what's in March or April? The spring equinox, okay? But he's not even aware of that concept. Your 2618 lands you right on that one fib as well. Another way to look at this for more Fibonacci confluence is a simple fib retracement off that pandemic low. Let's use a fib retracement and see if we have any Fibonacci confluence for this 3141 target. Got to add my fib levels back here. And let's go ahead and do this. Add our 486, 786, 618. There it is, the 618, 3188, and the one fib at 3141. The one fib giving you what in the ABC correction would be A equals C, or if you're looking at Gartley's book, Profits in the Stock Market, this would be AB equals CD. 618, as you guys know, a key Fibonacci level, and a 30-year study done on the marketplace in equities, the 618 was the most commonly retraced to fib by the S&P. That's at 3188. My target is 3141. So you can look for Fibonacci confluence multiple ways. In addition to that, the other pattern that you can see here, just looking at my screen, is we have a very obvious dragon pattern forming. Not going to use this Fed wick here, although it doesn't change the ratios at all. We have a 50% retracement and then almost a 786 back to the upside. So we have a dragon pattern forming, did the fib projection for that as well. We have this key target of 3141, and the question would be, well, are we bullish at that point? Because Mike Wilson, again from Morgan Stanley, thinks that's the bottom, and then it's just more upside the rest of the year. And he and Morgan Stanley don't have a severe recession priced in. If anything, a mild recession is what they're pricing in, okay? So this is the key test for the S&P. The market declines, it comes down, spring equinox time frame, 3,000, 3141 S&P. If it bounces back up and this rally eventually fails, maybe makes some different types of bearish shapes, double tops, keeps declining, if you sweep this low, you're going lower. Only 4 times since 1928 has the S&P had 2 down years in a row. Isn't that incredible? Only 4 times since 1928, the S&P has had 2 down years in a row. Each of those 4 times, the second year was worse than the first year. So this first year got us down from the all-time high. What was it, 24%? Let's go ahead and measure this really quickly. I think we got down 24%. Measure this from the high to the low, 27.62. So again, knowing that if we end up having a down year again, you are defeating 27.62. And right now you are only down about 17%. And what is again the average? The average in a recession for the S&P to decline? 34%, 33%. Look where 34% lands you at my one fib, 3141. Now, again, none of this information is top secret. I guarantee you Mike Wilson knows some of this. They know some of these averages. They know the recessions, what the price of the S&P should be. This is why you see the market savvy technicians, the strategists saying, yeah, we could go down to 3,000, 3141, maybe 3,000 because the market likes to overcorrect. And this is why they're looking at that, because that is a recession average drop. Okay, the recession average drop. My point to you is the rally off of this bottom, which I believe this bottom will occur around the spring equinox, which is March 20th this year. So sometime late March, early April, you're going to find this bottom here, and then you're going to rally back to the upside. If that rally fails, you're going deeper, and that's when you start looking at your super bubble targets. Let's go ahead and go to the next iteration here. So where would the super bubble target be? Looking again on the weekly time frame. Here's the pattern that I drew you, my ABCD pattern, the market symmetry at 31.41. You can see that's a 34% decline from the all-time high. If you came down to the 1618, you're looking at a 24.13 number. And if you start looking where the pandemic lows are, you can see the 24.13 puts you right back near the bottom of that pandemic range. If you look at the 2058, you're looking at 1893 off the trend-based fib. Now, looking at this 34, what else is that? Fibonacci number, okay? Fibonacci sequencing is very important. 50%, that is the average decline in every single super bubble that the market has had, 1929, 2000, 2008, and that would be the average decline for this as well. So you're looking at a minimum, in my view, if you lose 31.43 and come to a new low, you're coming to 24.13. And if the market really falls apart, think financial crisis, think 2008, think maybe bank failures or issues in the bond market, a currency crisis, any of those components, you're coming down to 1893. Where's the Fibonacci confluence for this? Well, again, let's take a fib retracement. Let's go to the pandemic low to the all-time high. And let's put some levels on here once again. We've got 786. We need our 1 fib. We need our 1618. We need our 1272. And let's see, what does that give us? This number here, the 1.128. Oh, that's the key number that I wanted to share with you, right? The 1.128, where every single number has hit, or every single 3 sigma bubble has hit. Let's just look at that right here. Our Fibonacci confluence, again, for the 1.128 that we went over in the beginning, look at that, 1855. 2058 gets you 1893. 1.128 gets you 1855. Again, a 61% decline, basically fee 618. Okay, that's what you're looking at in that ratio. And guys, you know what's interesting? The market bottomed in March of 2009. I told you at 666. Look at this rally. The rally here up. Okay, the rally here up was 6.66%. Really curious to see if this rally up will hold at this level, making this a market top for a bear market rally to then descend from. So you would have a market bottom at 666, a market movement up of 6.66%, and then a decline. You see little things like this all the time in the marketplace. Let's look at this on a daily time frame, and we'll wrap this video up. So looking at the daily time frame, guys, we pull a simple fib retracement from our largest wave here, that Wednesday, August 17th or August 16th candle, 2022, down to our low here. Look where your 618 is, 4,005, giving you very strong resistance. When you look at this on the daily time frame, through this and a mini cough, a Wyckoff structure. This is a beautiful textbook Wyckoff, establishing your range, getting a down thrust, bouncing out of your range, hitting resistance. This would be your Livermore pullback, with now you are pumping back up. And what happens at these points is either price will break out to the upside and go up and then reaccumulate, either make a distribution box or accumulation box and then move up again, or what you will often see is price will fail at the exact same resistance level, and this is why you see so many double tops in the equities markets, in the indices, okay? You fail at the same resistance level, you print the double top again, our larger dragon pattern that I just showed you guys on one of the previous charts, the larger dragon pattern, and then you see price re-enter the range, maybe make a series of lower highs, and eventually exit the range, pull back, and fall down to the downside. And that would be your declination in price. What's the catalyst for that again? Debt ceiling potentially being struck, 31 trillion in national debt. Earnings for the big majors coming out worse than expected, or guidance being very negative. The Fed is meeting coming up here early February. Lots of different catalysts, guys. Stay tuned for this channel. Please do like and subscribe. And guys, really do appreciate your comments. I will answer all of them, as always, in the YouTube comment section. You want to trade with us? Check out our Discord trading room in the video description as well. Talk to you guys soon. See you Wednesday for the next S&P video.